Good to see you as always.
Yeah, great to see you guys.
So the market rallied up a bit, pulled back again. This kind of plateauing, as it were, you think is actually a great buying opportunity?
Yes, I mean, I think the market has been stuck. Volatility's been shrinking, and I think there's a general belief that because we're late cycle, and there are a lot of scary things out there, that this is going to lead to a break on the downside. And what we found is that if you look at in the last 70 years, whenever the market's been flat for 20 months and 12 months, but really hovering near all-time highs, three times it resulted in an upside breakout for equities.
What's the why this time?
Well, I think that it's going to have to start with the belief that we're not late cycle. So I think that cyclical data has to start improving. So I think in our case, we think the U.S. PMIs really will start to bottom in the fall. And that's because not only destocking, but, oil's kind of a little bit of a tailwind for the PMIs. And I think the second factor is that this inventory sort of destocking that took place because of trade wars, at some point, businesses have to start expand again. So I think that's going to be the cyclical lift. But now that there's so much cash on the sidelines and, a lot of doomsayers, I mean, most of our clients are cautiously positioned. I think if things start to improve slightly, we get an upside breakout.
And US PMIs can start to improve even if trade and Eurozone data doesn't improve?
Yeah.
Not yet. Richmond was negative today.
Yeah, but what you have to keep in mind is that the PMIs are mean reverting because you're really asking same, better, or worse. So eventually things drift back to 50. But interestingly, if you had to say what's the best leading indicator for the PMIs, and it probably has a 50-year track record of almost perfectly calling the turns, it's the 10-year minus 30-year yield curve, 9-month change. We started at the start of this year, we pointed out that at the start of this year, that PMI was the yield curve was telling us PMIs would be below 50 by the fall. And in fact, that's indeed what's happened. So that's also telling us we're starting to see a turn into late this year.
You put out this theory that some of the tumults we've seen in the repo market, this short-term funding squeeze, might have something to do with the delayed WeWork IPO, and then you got a lot of grief on Twitter. Explain what you mean.
Yeah, I mean, one, I'm not trying to do a pile-on to say WeWork is going to destroy the planet. But one thing that I think is important to keep in mind is that the turmoil in the repo market can be caused by concerns about collateral. Now, the single biggest piece of collateral in the repo market overnight is treasuries, and no one's really worried about taking treasury collateral. But the second largest piece, which is almost 30% of the repo market, is MBS and CMOs, which are held by REITs. Well, who's the largest tenant for the REITs? WeWork. They have 24 million square feet of lease space. They're the largest tenant in New York, Chicago, London. But more importantly, 20% of the funding for REITs is typically overnight repo. So if you had to say last week was a week where people started to think about the solvency of WeWork because they have 12 to 18 months of runway left, it could possibly be a concern for taking some collateral, and that could cause repo prices to move.
So is that a sign that we should be more concerned about the spike in the repo rate or less concerned because there's something specific which once it passes shows there's no other liquidity fears in the marketplace?
Well, I think if it's a concern about the quality of collateral, that's where Fed intervention actually works quite well because the Fed essentially can step into the market and say, listen, how much liquidity does this market need? And, you have to remember WeWork has 24 billion, I think, of operating leases. So, I mean, it's a significant number, but it's not so big that you can't fix it with the Fed.
I don't know. I mean, Grasso, what do you think about that theory? Wouldn't we have seen some sort of turmoil in the REITs, which we really haven't?
So I think the overall, when you look at the corporate real estate market, it's a huge market. So you're talking about a number that is just exponentially more than what WeWork owns in that marketplace. I don't disagree with Tom that maybe there's an issue or an underlying knee-jerk reaction that could have spooked the markets. And if that's the case, then that won't be a long-standing because I don't know. I actually do know that WeWork isn't enough to actually to spook and ripple those markets. So if it was just a knee-jerk reaction, okay, and I don't think it should be looked into further, but I'm not sure that's it.
Really quickly, what's going on with Bitcoin? There's a bit of a coin crash across all the altcoins right now.
Yeah, I would say it's one, since July, we've been telling our clients that we need the Bitcoin misery index to get back into lower levels. So we've been waiting for Bitcoin to sort of drift lower. But this week, I think it's really been the disappointment around the Bakkt launch. Bakkt went live on Sunday night, and it's a very important project. It's really going to be a high-quality way for institutions to do one-day settlement with Bitcoin. But, should Bakkt have had a blowout first-day launch? I think that's may have been some expectations, and I think that's a disappointment. But I think it's kind of improper to judge the success of Bakkt or even Bitcoin just on one day of Bakkt's launch.